Now we talk about the usage of payment function in Excel. In this example, Emily is buying a car and she is choosing between the two loans that are being offered by the dealers. The full price of the car is $34,500. The first loan requires 0 down payment and the interest rate is 0.99% annually, and the length of the loan is 5 years. Therefore, there are 60 monthly payment. The second loan requires Emily to pay a $5,000 down payment, and the interest rate is a little bit higher at 1.25%. Before we carry out any calculation, it's important to ask ourselves which is the objective in here. Here, Emily wants to spend as little interest as possible for the entire loan. So let's think about how to calculate the total interest of the loan. If we know the monthly payment, and then we know the total payment, the total interest would just be the difference between the total amount paid out and the price of the loan. So with that in mind, let's do our monthly payment first. Equal to PMT. As you can see in the hints here, first of all, we need the rate. The rates given here are on an annual basis, but the payment are on a monthly basis. So we need to be very careful here. Instead of an annual rate, we actually need to divide it by 12 in order to convert that to a monthly rate. And the number of payments, which is the second option here, is simple, it's just 60. The present value of the loan is the loan amount, which already calculated in row 5. And the future value for this car loan is 0, so we can safely ignore that. And the last option, type, is basically asking is it due at the beginning or end of the month. So we just choose the default option. So we can actually complete the calculation here. So for the first loan, we pay $589 a month, and we can just drag to the right. We see that the second loan has a lower monthly payment. Does this mean that the second loan has a better deal in terms of total interest payment? We'll see in a second. The next step is to calculate a total payment, which is actually quite simple. Total payment equal to monthly payment times the number of payments. That's it. So we do that. As you can see, the total payment is a little bit higher than the loan amount, which is understandable because you pay interest. Now the difference of the two amounts actually is the total interest paid. So we're going to calculate that. One thing to notice that is in here in accounting form, this already it's in negative, meaning this is cash outflow. So we need to, instead of minus, we just say plus, because the loan amount in the original problem setting, loan amount is positive. So that's the interest paid for the first loan, and you can see between the two, indeed, the first loan gives you a lower amount of total interest, and therefore Emily should choose this loan.